You're in the world of corporate credit, but just to give you the chance, tell us where you are, where you work, and the organization you're representing.
I am the CEO of Stanlib Credit Partners, a subsidiary of Stanlib Asset Management, specializing in credit and interest rate management within the fixed interest division of Stanlib.
Excellent. What we want to discuss today is, you were telling me about some shifts in the world of corporate credit. So in the past, obviously big corporates depended quite heavily on their relationship with banks for funding, both in terms of business expansion or just generally their kind of credit lines. And you indicated that there's been some kind of regulatory shift with regard to where pension funds and other players can invest, which has resulted in a bit of a move of that away from the banks into the asset management environment. So just set that out in common, easy language for our viewers.
I think there have been four important developments that have resulted in a shift or paradigm shift within the credit space. Firstly, and most importantly, Basel III, so the adoption of more stringent regulatory standards with respect to banks, which is going to mean they're going to lend less. Secondly, changes to Regulation 28, which happened last year, which govern the assets, the prudential limits for pension and retirement funds, which is made clearer what they can do in the interest rate and credit space, and has importantly removed the requirement of credit ratings from those prudential limitations. Then there's Notice 1503, which does the same thing as Regulation 28 does for pension funds, for SISCA funds, in other words for unit trusts. That's coming to effect in April this year, which has a similar effect of effectively removing ratings and creating the capacity for a broader universe of credit investment by unit trusts. And fourthly, last year as well, the JSE introduced new debt listings requirements for corporates, which effectively increase disclosure and provide investors with a greater deal of access to information in respect of borrowers borrowing in that space.
Okay, so that's all fabulous, but in terms of what it means for someone like you, because your fund used to operate with Brait, now you've moved into the Stanlib environment, just explain to me what it means in terms of the reality on the ground for a big corporate, you know, whether it's a listed one or one that's considering delisting, in terms of where they would access funding.
I think the corporate would still probably be originating its funding through the banking space. So a bank, whilst not necessarily parking the assets on its balance sheet, would now play increasingly a role of an arranger. And increasingly, you'll find institutional investors going into the space, asset managers like ourselves, effectively giving both the retail and institutional market access to the space. The shortcomings of the investment space from those investors' perspectives as they stand or pre the kind of liberalization, if you like, of these credit markets is really, if you look at the listed corporate credit space, it's largely dominated only by high investment grade issuers, so no crossover or sub-investment grade issuers as you would have if you were an investor in the developed world. There tends to be also a sectoral concentration, so largely banks and state-owned enterprises account for most of the corporate issuance. There are other corporate issuers, but not many. The spreads are much narrower, so the average 7-year spread for which is the margins as a premium to risk-free at which corporates issue in the listed space are 145 basis points. And in addition to that, most of the instruments issued in that space are fixed rate instruments, in other words, requiring the investors to take a view on inflation. In the banking space, on the other hand, you have a much wider array of borrowers, people from a broader category of sectors, much higher margins at which they borrow, and a broader spectrum of credit as well. So from very high investment grade to sub-investment grade issuers. Thereby, by investors gaining access to that space now, they therefore effectively increase their capacity to diversify instrument types, issuer types, and pick up the margins at higher rates.
Okay, just a question to put this into global context. I know that when you talk about a market like the US, you've got the value of their listed equity, and then you've got this enormous world of corporate credit. And often listed corporations, they prefer to raise money for corporate expansion in the corporate credit markets because it just makes more sense and you don't dilute your shareholders. South Africa has a quite well-developed financial sector, as you can tell from all the jargon you've been reeling off here. But it's still relatively underdeveloped by comparison to those world markets. Is that correct? And would you say that this is going to be an expanding area of kind of finance in this country, that you'll just see more and more of it and less on the sort of plain vanilla equity front?
I think what's happened is the credit markets here have largely just been intermediated by the banks for many years. So since I think the first corporate bond issuance was in the early 90s, SA Breweries, and since then it's grown very gradually, but it still tends to be focused in the financial services space. The banks have largely been in control of that, supplying that credit because of regulation now, and because of the global trend to move rating agencies out of regulation, which has happened here now too, in the wake of the global financial crisis in 2008. You've really created a sort of democratization of the credit space, and you'll get more people accessing that space here, whereas traditionally historically they've gone through the banking space to access that credit. The limitation has been the sort of costs and disclosure associated with it, which has kept some people out of it, because you can't, if you aren't borrowing billions, it's very hard to make a market, and so the benefits of listing become somewhat questionable in the sense that, well, you're listing something, but it's not really going to trade because you're only borrowing 500 million, and that's really what's happened here. The corporate issuance has been small. A lot of it that's happened. The asset managers buy it and it just gets locked up as kind of yield sweetener in a portfolio. It never really trades. So hopefully now, with an increasing number of players coming into that space, you'll get a pickup in liquidity, certainly a pickup in interest. As other asset managers will have to sort of follow what we've done at Stanlib and increase the infrastructure and resource that you need to in order to. Remember, you're now dealing with assets that aren't standardized. They're not all just bonds. They're all sorts of loans. It's not rocket science, but it's more like banking comes to the debt capital markets, if you like.
It all sounds great, and it sounds like a maturing process. On that note, I assume elsewhere in Africa there are similar developments, but it's much more early days. In other words, there's just still a fairly straightforward sovereigns plus like one or two. But in time, one hopes with the deepening of markets outside of South Africa, in sub-Saharan Africa, that you'd see this kind of thing evolving as well.
Absolutely. Most likely to happen, I think, in East Africa, sort of Kenya, Tanzania, and in West Africa, Nigeria. Obviously, markets with big, vibrant capital markets, and likely to see an increase in that. But I'd say at this stage, as you say, largely still dominated by sovereign issuance.
Yeah. Okay, here's a question I've been itching to ask a credit expert like yourself. I often talk about on this show how, a lot of people who are equity market bears like to say that, oh my goodness, the global credit crunch has resulted in this absolute proliferation of debt, and that debt is out of control, and people are like overindulged households, that nations are all mad, and that we're all on a road to nowhere. My counter to that is that all the debt that exists out in the debt markets is owned by someone. It's not like we're in debt to the planet Mars. So for every buyer, there's a seller. In your experience of the credit markets, do you think that we're in a situation where there's just like we've got a debt-fueled sort of nightmare happening here? Or is this part of the normal evolution of markets where you have investors that want the debt and issuers that want to issue it?
I think certainly there was obviously a time where borrowers were raising more debt than they could probably repay. That's kind of in the run-up to the global financial crisis, and that resulted in the indigestion that we had then. What's happened since then is the value of that debt has been adjusted, mark to market. People have had to sell it off at a discount, or people are sitting at a lower value. But in terms of new issuances that are happening, that market adjustment's already taken place. So from an investor's perspective, it's actually a very attractive time to invest because margins are higher, leverage multiples are lower, so borrowers are being able to borrow less, and debt covenants, the terms on which people borrow, are tighter. So on a risk-adjusted basis, the asset class actually presents a better investment opportunity than it has for many years.
Great answer. And one just final corollary to that is, what about defaults? I mean, have there been lots of defaults, or do you tend to find that when someone who is a sizable issuer is in some kind of trouble, that it's in everybody's interests just to kind of do a workaround, restructure the cash flows if it's a business taken off the market, or if it's a sovereign, negotiate and so on and so forth? I mean, realistically, have there been so many crashes as people somehow imagine?
No, I think it's overblown. I mean, I think there have been a fair amount of restructurings, if you like, which aren't defaults per se, but kind of amending the terms and extending the duration of loans. There's been a fair amount of that, not so much in the South African context, but certainly in a global context, in Europe in particular, and to some extent in the US. But I think in terms of debt capital market default levels, they're not out of line or out of trend with historical trends for the relevant credit rating of a particular borrower.
Philip, excellent. You're definitely my default credit guy now, whenever I'm going to have any questions like this. Yeah.